Okay, open-end credit or revolving credit is the topic for 5.1. Using credit. Using credit means you borrow money to buy something. You borrow money with your credit card or loan. You buy the thing you want, and then you pay back that loan later with interest. There's two main categories of consumer credit. There's open-ended revolving credit, and it can be used repeatedly for purchases that will be paid back monthly. Though paying the full amount due every month is not required. For example, credit cards, or you can have a home equity line of credit at a bank. Okay, closed-ended credit is a one-time loan that you pay back over time in payments of equal amounts. Auto loans, for example, auto loans and mortgages. Today we'll be talking about revolving or open-ended credit or loans. So revolving credit or open-end credit allows you to borrow funds over and over again up to your credit limit and approved maximum amount. This maximum amount is set by your lender. You decide how much money you will borrow or charge and how much you will pay back each month, aside from any minimum payment requirements. Okay. Revolving credit examples are credit cards and retail store credit cards, a personal line of credit at a bank, or a home equity line of credit, which is typically at a bank. And they show you, you can, with the credit cards and store cards, you can borrow money with a promise to pay it back later. If you don't repay in full, you pay interest on the amount you owe. And typically that's pretty high interest rate. Personal line of credit, you can have access to set amount of money used when needed. You don't pay the interest until you borrow. And the home equity line of credit, it was where you borrow against the equity in your home, the value of your home. Secured as home is used, the secured home, your house is used as collateral. So if you don't pay it back, they'll take your house. The difference between credit cards and debit cards, well, credit cards is where you're borrowing money to be repaid later. Credit cards is someone else's money that you have to repay later. A debit card takes money directly out of your bank account. This is your money, so you don't have to pay it back when you use it. You just have to be sure there's money in your account before you use the debit card. So here's a chart showing the difference between credit cards and debit cards in terms of interest, fees, credit history, rewards, liability, and reimbursement. So do credit cards charge interest? Yes. Debit cards? No. Credit cards have late payment fees? Yes. But debit cards have overdraft fees, which means if you use your debit card and you don't have enough money in your account, you'll get an overdraft fee. Can you build credit with a credit card? Yes. With a debit card? No. Do these offer rewards? Credit cards a lot of the times do, like cashback rewards. Debit cards, no. Liability, $0 liability protection if you report in a timely manner. So if your credit card gets stolen or there's there's a charge on your account that you didn't make, you don't have to pay anything as long as you get it reported in a timely manner. For a debit card, $50 max if it's reported within 2 days, up to $500 within 60 days is what you'll be responsible for paying if someone uses your debit card unbeknownst to you. Reimbursement, some offer insurance or warranties on purchases, possibly, but for the debit card, you must deal directly with the merchant or, your bank. Is there an annual fee? Some credit cards, yes, some no. Debit cards, typically, no. So here's a YouTube video from the Money Coach that we will watch.
Grammarly can help you write quickly and confidently, so you never have to slow down at work. Stay on top of emails.
Meet Jasmine. Jasmine is a college student attending State University. Like many college students, Jasmine has a lot of things she needs to buy: books, laundry baskets, food, and so on. And she can pay for those things with two types of money: debit or credit. Debit is money that comes from a personal bank account. Credit is money that is lent to you by your bank. For example, let's say Jasmine has been using a credit card. Each time Jasmine uses the card to buy something, say a $100 textbook, her bank is loaning her the money. While that sounds nice, be warned, the bank isn't giving Jasmine this money for free. They expect her to pay a certain amount of money each month, called interest, if she doesn't totally pay off her balance by the due date. As you can imagine, this can get very expensive very quickly, especially when factoring in the high annual interest rates, or APRs, that are charged by these companies. However, there is a solution to this rather scary problem. As long as Jasmine always pays off her balance in full by the monthly due date, she'll never pay a cent of interest. Jasmine is shocked and thrilled, but still isn't quite sold on credit cards. After all, with all their flaws, are they really worth using? The short answer, as long as you avoid running up a balance, definitely. So why is that? Well, free money for starters. Most credit cards offer their users rewards, like cashback or airline miles, each time they make a purchase. For example, let's say Jasmine's credit card comes with 2% cashback. That means if Jasmine spends $500 per month, then at the end of the month, she'll automatically get $10 back, no questions asked. Then, if that wasn't good enough, responsibly using a credit card also allows Jasmine to build a great credit score. This is a calculated number between 300 and 850 that summarizes your credit history, covering everything from your payment history to the age and status of your accounts. While we'll teach you more about your credit score, including how to get and improve it, in our next video, Credit Scores and Reports 101, just know for now that most credit cards actually require a credit score of at least 600, plus at least $15,000 in annual income, and a reasonable debt payment to income ratio, generally below 36%. However, thankfully for Jasmine, who lacks both credit history and a full-time job, she shouldn't have a problem getting a student credit card. In fact, the online application will take all of 5 minutes. She'll just have to be a full-time student of at least 18 years of age, with either a small amount of income, like from a part-time job, or a credit-worthy cosigner. However, at this point we have to say, be careful. Taking on a cosigner is no small matter. The account is still in your name, so any credit mistakes are on you and your cosigner. Plus, your cosigner is even liable for any of your missed payments. If Jasmine isn't quite ready for that level of responsibility, she can instead be added as an authorized user to her family's account. Not only will this allow her to get her own credit card, but in a few short months, the credit bureaus will treat her parents' credit score as her own. Sounds pretty great, right? Well, this strategy isn't a cure-all. Even though Jasmine isn't liable for payments on the account, her parents still are. Plus, many lenders will want to see you successfully handling credit on your own before giving you a major loan. Hopefully you and Jasmine now understand the basics of credit cards. Be sure to watch our next video, which covers everything you need to know about credit scores, and be sure to check out our website, where you can find more.
Okay, so slide 9, the pros of using a credit card. It's one of the easiest ways to establish credit. You can buy now and pay later. They're convenient. You don't have to carry cash. Make and hold reservations at a hotel or for a rental car. They're protected against fraud. Debit cards are not protected. They can be free to use. Some have rewards. They can be used for funding for emergencies, and they can be used to shop online. The cons of credit cards. Temptation to spend more than you can afford. There are fees and interests that can be very expensive. There's a great potential to accumulate debt. And misuse can destroy your credit. So, choosing a credit card. When comparing credit cards, look at the finance charge, the annual fee, late fee, if there's a cash advance fee, a balance transfer fee, and use the Schumer box for comparison. It's created to help consumers understand and compare credit card fees and rates. So right here, you can see here's the APR, the annual percentage rate, There's a balance transfer rate, cash advance. See, these are pretty high percentages. Okay. The key information in a Schumer box, that's what this is. The annual percentage rate for purchases. This is for every credit card will have one of these. The interest rate you pay on financed purchases, which may include introductory and long-term rates. Other annual percentage rates include interest rates for balance transfers, cash advances, defaults, etc. 3 of variable rate information, if applicable, how your interest rate can and will change right here. And the grace period, the period of time after your billing period ends when interest charges are not yet applied to your debts. Okay, then you can pay off your card in full and not have to pay any interest if you have don't carry a big balance. So the key information in the Schumer box continued. There's a finance calculation method, how interest is calculated if the credit card balance is not paid in full each month. This will explain how. It's the average daily balance multiplied most of the time by the annual percentage rate. Finance charges, the minimum amount charged if a balance is carried over month to month. Okay. Annual fee, the once a year charge for using the card. And other fees, foreign transaction fees, balance transfers, cash advances, late payments, etc. So here's TC's 2 cents. The best practices for using a credit card: don't charge more than you can pay. Don't max them out. Keep utilization level low, around 1%. Pay the balance at the end of the month to avoid interest charges. Pay on time. Don't apply for too many cards in a short period of time. That can damage your credit score. So here's your activity. You're going to open 5.1b, the credit card statement activity, and you can work with a partner or by yourself and fill in the answers for that. And there's an interactive credit card statement that you can also utilize. So right here is 5.1b, the credit card statement activity. Find the following items on the credit card statement and then write down your answers for each one. Okay, and here is the credit card statement that you'll need. Okay, so read the credit card statement. This is similar to something that you would get in the mail if you actually had a credit card, and write down your answers on this sheet. And then when you're done with that, there is an interactive credit card. Let's see if we can find it. I'll include this also, but then here, understanding, here's an interactive one. If you want to use this, this is in the classroom for help. If you want to use this as a resource. And finally, for closure here, okay, good credit card habits of paying on time, paying in full, and limiting card utilization leads to good credit and gives you better financial choices. So you're going to do 5.1c also, where you're going to compare 3 credit card offers and decide which one is the better offer. And that looks like this. 5.1c, and this will be in classroom also. Okay, find 3 different credit card offers and fill in the table below. Credit Karma lists the top 10 credit cards. You may use this site or another of your choice. Using this information, which credit card would you choose? Okay, so go ahead and fill that out also.